Well, hello everyone, and happy St. Patrick's Day for everybody out there who's going to try to enjoy it. This is Ken Winans and Stephanie Larson, and we haven't talked to you in a while, but it's amazing how fast the world changes between videos as tragically as events unfold in Europe with the Russian invasion of Ukraine. Certainly a lot of you have been calling and asking us about it, and as a market historian, unfortunately, these kind of things seem to happen during inflationary cycles. During the 70s, we had several Middle Eastern wars with nuclear capable adversaries. So unfortunately, things do seem to rhyme a bit as it goes forward.
And an embargo, apparently.
And an embargo.
They're back in fashion.
Yep, there we go. Embargoes are all back in fashion yet again. So anyway, but with all seriousness, there's a lot going on. We've been very busy, and we just wanted to give you an update. We have been talking to a lot of you lately. We've been trying to go around and see as many clients as possible, and we just thought we'd like to summarize a couple of things. So let me start off with probably the most important thing is, as of yesterday, there has been a pronounced change in Federal Reserve policy that, rates are going back up. Rates have been low or at these low levels for almost a decade, and there is definitely going to be a normalization of interest rates going forward. And it will affect all of us. And of course, that is partly because of the inflation problem that, as you all know, all you have to do is go to a grocery store or go by your local Starbucks and buy a coffee, and you'll see just how much prices have gone up. We're certainly at the gas pump.
Yeah.
So with that being said, I'm going to talk about the equity side first, and then Stephanie will certainly enlighten us with her views on stuff.
Well, about the inflation first, though, the rate hikes, this is a good thing. I know it might not feel like it, but it needs to happen. They agree to a quarter point. They're discussing 6 more, possibly quarter points. The only reason why I'd say that number would change is if they decide to do a 50 basis point cut or something like that, then the quantity would change. I've also heard from some experts that they think up to 13 hikes in the next 2 years. Mm-hmm. But that just brings you towards a 3% normalization. That's nothing. This is something we desperately need. They're late for it, so I'm glad they finally got off the sideline and they're moving it. In regard to the inflation subject matter, we know the 7.9 number just came out. We were discussing it several times over the last week. That figure was also taken prior to really the full ramifications of what's happening in Europe has really hit the market. I do find it interesting that crude is now back under 100, and yet gas prices haven't moved an inch. I think that's going to change, and it's going to change sooner rather than later because there's some political pressure there that will be put on these oil companies. But the thing with inflation is that a predominant component of it is energy. So expect that headline number of 7.9 to actually continue to go up until things settle in Europe and we can have some normalization there. So if you think that this is the end of it, it's not. And don't be scared when you see a bigger number. But understand that the major component is energy costs in all forms: oil and gas, natural gas, crude, all of it. Correct.
And also keep in mind, and I know we've talked about this many times. There's no such thing as short-term inflation.
Yeah. Once
it takes root, and it's taken root globally, it's not just the United States. This is everywhere is having the same problem. So again, this is just something we're going to have to operate in. But let's briefly talk about the stock market, and we'll switch to the bond market and commodity, or stocks and commodities. So let me start with the good news first. Commodities. The use of the commodity ETFs did work very, very well. They had a big run up, especially through January and February.
And even today.
And even today.
Yeah.
Big run up. So I am very, very glad we put them in the portfolios. I do have to apologize to those of you that had the shock of getting K-1 tax forms for last year. Sad. I'm surprised that they went out as late as they did. We do apologize. But what I would tell all of you, and certainly tell your accountants, we do plan to use these investments into the intermediate future. So let them know that we're going to have this going into next year.
Sorry.
Sure.
Of course. I worked with Brittany today. She's going to be sending an announcement through Tamarack. If you are not on Tamarack, and obviously it'd be hard for you to see this video, we'll send it to you separately, just straight to your email. There is a single website that has all of the K1s. So if you're like me, I got 3 K1s on the commodities. I somehow lost 2 of them. I do not know where they went. And so I registered for this website, and you can download all of them at once. And so just send them. If you think you don't have them all, or if you lost one like me and you just want to get them to your CPA immediately, from our understanding, the Terracums, so the wheat, soybean, cane, which is sugar cane, and corn, all have them. DBC, which is the Invesco one, has it, and copper has one as well. I've done a lot of research the last 2 days. I do not believe silver has one, and the gold that we're in today, because they're both iShares, I don't believe they have a K1. I think it's just straight 1099. But if anyone receives one for silver, please let us know immediately. But it's just the other 6, the Ford Terracum, the DBC, and copper. So if you have all of those, then you have them all, and you don't need to worry. You can just send them off to your CPA. But the announcement will come out with the direct link. Create a login, download them whenever you want, and it'll be good for next year, because obviously since we're invested in them this year, again, you'll receive K1s next year, but you could hopefully get them earlier through the direct website. Unfortunately, we don't have a corporate login like we do with TD or Schwab, where we can just download everybody's 1099s and send them to you. It has to be on an account by account basis. So unfortunately, you're going to have to make the login, and you're going to have to get into that site to download them, but we will do our utmost best to help you do that. So just let us know and reach out, and we'll take care of that.
One final point. Many of you know that the brokerage houses, especially during the COVID years, have been doing multiple revisions on 1099s. Again, I would caution you to not necessarily rush to do your taxes way ahead of time, because I just know that you're going to get a revised 1099 from TD or Schwab. It's nothing that we've done. It just seems to be what happens in this situation we're in right now.
We also post them to Tamarack, so you should be getting the revisions as they come out. Usually it's Mindy, but she'll post them every Friday as soon as she can. I know we just got a revised ones, I think last week.
Yeah. So unfortunately, it's what happens.
Yeah.
So let's get back to investing.
Yes.
So as far as stocks go, there has been a pronounced shift in leadership. I still do think this is a bear market, although we've had some very powerful rallies the last couple of days. Do remember that bear markets do in fact have these very convincing runs. But so it just simply means
traps.
Yeah, they call them bear traps. So you just want to be careful. I would not commit all your cash buying into this situation. I think it's going to be very important to see how earnings look, over the next 3 weeks to see where we're at. But there's no doubt that the leadership stocks are in energy, especially oil and gas. Anything that is a commodity-based play seems to be doing very well. And last but not least, although we're all trying to forget about COVID, there are very clearly companies themselves, not industries, but companies that have done a very good job navigating the COVID world. And clearly there's a whole bunch of companies that were caught flat-footed and way off the mark. So we're going to be positioned in the portfolios accordingly. We are still using hedges as of right now, even though we're going to be reducing them if this rally does take hold. But as I said, I'm still of the camp that this is not going to be a great year, that we've got a lot of headwinds coming up between the interest rates climbing, future inflation, geopolitical issues, earnings themselves, post-COVID hangover with logistical supply chain problems. That's just to name a few of them, not to mention that pretty much every stock on planet Earth right now is way overvalued on a historical scale. So if the earnings are not good in the next 3 weeks and the stock's overpriced, there will be no prisoners taken. They will be paying a dear price. Other quick thing I would bring up, and as far as commodities go, we will from time to time take profits. We had big profits in wheat, and we did take a third of it off the table because it was just crazy how fast and far it had gone up. We will be doing that with stocks as well. So again, we're doing a lot of things going on right now. At the end of the day, it's just getting the portfolios in position.
I think you guys can see if you follow your confirmations when you get them in your email from the custodian that, we've been really active this year, cutting, rotating, hedging the commodities. I have gotten a couple emails this week, this week, probably from 3 people that were asking about when we were going to take the hedges off. In our very aggressive accounts, we actually had a secondary hedge on that we took off this week. We discussed today because we're at an inflection point where we're hitting a major resistance line with the S&P. And so most likely we'll start trimming the hedges tomorrow. The good thing is that I reviewed all the accounts and we're well in the money on the hedge. They've really helped dampen the volatility. I know this hasn't been a fun year, watching the market do what it's done, but our risk mitigation protocols have helped. The commodities have helped, the hedging's helped, our cash has helped, and so we are ahead of the market, which we're very proud of. But I know it's tough. But our goal this year is to just keep navigating it so that we can make up any of the losses from earlier this year and just keep plugging along. You know, the summers can be difficult, but we will play the seasonality and we'll play what's going on in the market, and earnings are going to be crucial, but you'll see us be more active after earnings season, you know, putting money to work or not, depending, lifting the hedges or adding to them. Just kind of depends on the direction. But like I said, we were discussing today in an investment meeting that we're at this very interesting inflection point on a technical basis. So,
absolutely.
Yeah.
Let's talk about the bonds and what's
Sure.
going on there. Oh, and by the way, has everybody noticed that Stephanie is speaking louder now?
Trying.
You've all been making comments. Please have her speak up.
Trying.
And so she is. So you notice she's enunciating that much better.
I am a soft speaker. I am Norwegian and we speak very softly, and British, so that's just natural. But I am trying. I will work on it. So the bonds had a really interesting week last week. I think part of it was the run up into the Fed meeting, and what happened was the spreads widened very dramatically. So think of it when you're buying a house or selling a house. The buyers all of a sudden were offering a lot less and the sellers were asking for a lot more, and everyone was like, where's the business? And there was no business going on. I have had a really hard time with our broker dealer securing specific bonds, really thinner traded bonds. On several occasions, she had to work 5 days to get me a bond that we wanted. And, you know, and that's hard. It's hard on her, it's hard on us. You know, there's things we want, but you wait for the price. You know, so we waited, we got the bonds we wanted. I bought a few more this week, been really active in that space. And these ones were easier to get. So I've noticed that the market has shifted with the spread issue. We're just discussing today on some bonds that we've been eyeballing that were really attractive and new. We haven't seen these bonds offered in a while. So we were really excited that it seems like maybe some of the larger institutions are starting to maybe rotate in their portfolios to maybe lower duration or go a little shorter. And so we're seeing some new issuances that we haven't seen in a while. So that's interesting. The prices have softened a little. That's to do with the interest rate hikes. You know, and the thing to think about is that if I sold Ken a bond that matures in 5 years, you know, last year, and he's sitting on it and it gets 5%. Well, if rates go up and all of a sudden I can buy a bond from, you know, Amy for 7%, well, why would I buy the 5% bond from Ken? The only reason why I would buy it from Ken is if the price went down, because then I would accept the lower yield, correct? So as rates go up and hypothetically new bond yields go up, the existing bond prices have to soften. So I want to really prime everybody for that. That's going to happen this year, whether you like it or not. So you will see the prices of your existing bonds, especially longer bonds, soften more and faster than the shorter bonds. We have worked really hard over the last year to get the maturity schedule down in the accounts in the 2 to 5 year range. I'm trying to stay as short with the paper as I possibly can. So hopefully it won't be as dramatic as it could be. And the way that our philosophy works is we also obviously hold it to maturity. So it doesn't really matter if the prices move a lot. But it is going to get interesting. So last week, for the first time really since the lockdowns, the bond market was exciting. I thought it was interesting. So anyways, I also want to really mention, and Ken can talk about this too. I know that because of inflation, we really want to stress this with everybody. Cash on the sidelines is just losing money, no matter what. And so one of the programs that we're starting, and we have a handful of clients that are going to use it, we have our traditional bond portfolios where I can go as high or low on the maturity schedule as I want, obviously within logical reason. But if people want that money safer and they want to have it more liquid and they want it more available, we're starting a very short-term bond program. We're trying to stay within a year or two tops on all the bonds. The thing is, you're going to cough up a little yield. Instead of 6.5, you might get more 4.5 to 5. But if you want that security and instead of having the money in your checking account, maybe you have it over here, and I can make this custom portfolio for you of this very short paper, at least you have the money making money. Because there is no secret in our industry about how wealthy people stay wealthy. They have money constantly making money. And in an inflationary cycle, that's really important. So we think this is a really good program because it's specific. It's if you specifically want safe, short money on the side that you normally would keep in a checking account or a savings account or a CD, at least you get a little more than it over here, and we can put it to work for you. If you want to expand.
No, I mean, I think for those of you in the audience who remember the 1970s, it was just it was a nightmare to have money sitting around getting nothing. And do keep in mind that and I think eventually the brokerage houses will have to start paying a relatively different rate or decent rate of return on money market accounts. But as of right now, they're not. And I think that there's going to be some questions coming from regulators as to why Treasury 90-day T-bill yields are approaching 1 to 1.5%, and money market rates, which are meant to be short-term, are paying still less than 1. People are going to start asking questions. But what Stephanie said is spot on. Whether it's through us or we met yesterday with a group of people who do secondary lending in real estate, i.e. hard money type formulas that are shorter term. There are things out there you can park money in and get some rate of return. So again, just word to the wise, be very careful about parking money for the next 2 years and turning your back on it. What you are going to guarantee yourself is a 14% loss in purchasing power, and you cannot write it off on your taxes. That's the worst of losses. So anyway, I know this video has gone a bit long. Folks, we just want you to know we're here. What I would recommend is take a look at your first quarter reports. Certainly will, and of course we have tax season also coming up on the 15th of next month. There's a lot going on. But if you do want to make adjustments to your allocation, I always say, let's look at the reports first. Let's see where you're at and adjust accordingly. And certainly we are always looking for situations where we can invest money and make things work. So anyway, I think, what do you think?
I think just prepare for maybe the third business day to get your report through Tamarac. So if you have any issues, if you receive only the physical copy, we will try to have it in the mail that first full business week, and so you'll get the full report as soon as possible. If you just can't wait because you're nervous or excited, then just reach out and we'll send it to you securely via email. But we want to just make sure everyone has what they need and are happy with that. Ken and I also do a series of seminars and webinars, by the way. We have a set coming up which we also are videotaping and we post for our prospects and clients and our partners in the industry. I think it'd actually be fun if we send it out. People wanted to hear a longer version of what we do for you every month in these videos, but you can hear what we talk about in respects to the industry and what's going on.
And complete with graphs. And you can see it on our website. There's a link. There's actually a link on the winansinvestments.com website. There's a link to watch our video on YouTube. So anyway, please, we hope you do watch it. And anyway, folks, take care of yourselves, and we'll talk to you again in a couple of weeks.
Yeah. Bye.
Bye-bye.